Hi folks, this is yours truly again. Um, this is us in at Calgary Canada Olympic Park, and that's me at the front, my brakeman at the back there. This sled here weighs approximately 400 pounds, and this is the start of the race where we just have pushed the sled probably about 30 meters, 20-30 meters, and we're just getting in to start the descent. And I love this feeling right now. This is when you go from being extremely aggressive mode and very psychologically aggressive and physically aggressive. And then once I settle into the sled, I have to take a deep breath and completely change my mindset into a very relaxed and composed mode and get myself in connection with the rhythm of the track. And it's just an amazing transition from that push to go into the driving. And I just love this moment right here where we just make the transition and start the ride and get into a real nice connection with the sled. All right, pivot points. This is our section on pivot points, and we're going to cover various ways that we can use pivot points and the calculations and so forth. So before we continue, just want to point out that experience is what you imagine you have until, of course, you get more. I like that one. All right, pivot points. Pivot points are invisible levels of support and resistance based on the previous day's trading range and price action. They are support and resistance levels that are calculated based on the previous day's price at open, the close price, the high price, and the low price for the day, and we'll look at that in more detail. Pivot levels are used to identify potential turning points in the market and to, of course, discern entry and exit positions. They're used as a guide to determine potential daily range size for specific currencies as well. Naturally, like all other tools, pivots should be used in combination with other technical factors to analyze potential trade opportunities that come to fruition or present themselves in the charts. The highest probability trades will present themselves during the most volatile hours of trading, and of course that is typically at the open of a London session, early European, which is the merging of the Asian session and the European session. We see the highest level of probability during these periods, and in fact we did studies. We did studies of probability of trades that were made and systems and so forth, and the highest probability trades were at the merge of Asia and early European session. When the pivot points are calculated, it may look something like this on your chart, or typically it's a lot more spread out, and you may not even see the lower support levels or the higher resistance levels. But we will have definable lines on the chart that will act as levels of resistance and support in the market to help us to discern our trading possibilities. Calculating pivots. Each trading day a currency pair will open at a specific price, and it will trade in a range throughout the day, establishing clearly a high price traded for the day and a low price traded for the day. And then it will close as the day concludes and moves into the following day. So we will look to identify market movements and trading opportunities with an increased level of probability by mapping out our trading environment on the following day based on the previous day's range. So as an example of how to calculate these pivot points, we will look at our opening price. So when we look at a day's trading, For example, here we have Tuesday. So during this day of trading, we have our opening price, our high price that was achieved that day, the top of this wick, the lowest price achieved on that day, and the price at which market trades as it moves into the following day. So we will calculate the open, the high, the low, and the close. And what we do is there's a formula that will be employed to determine the pivot points that will appear on our chart the following day. For example, on the Wednesday, the following day, we see here that our central pivot point is here at 2100. And then we have our levels of support here. Support 1 and support 2 is below. Resistance 1 and resistance 2 is beyond the chart. But then we also have the midpoint between the central pivot and the first level of support. We also have a midpoint. The midpoint is also a natural level of support and resistance, as well as the midpoint between support 1 and support 2, which is off the chart. Now here's what it might look like on your chart. For example, this is a 60-minute chart, and we see here this is one day between these two vertical lines. We have our opening price, our low price achieved for the day, our high price achieved on the day, and our closing price right here. We will have our pivot points established for the following day, which will act as levels of support and resistance. Here is our central pivot point, and we have our first level of support, and of course the midpoint between the first level of support and the pivot point. And the second level of support falls below what we can see here on the chart, but on the above the central pivot point we have our level of resistance with the midpoint in between. And in this case, what price action does is it enters into the day of trading. It bounces from M2 to M3. It retraces all the way down to S1, support level 1, and rallies up to the first level of resistance. And in fact, M4, which is between the first resistance and the second resistance, which is not labeled here. Just a couple of lines in here to show you the price swings on the day.